Hey traders, in this video I'm going to share a powerful strategy that gives you the same edge institutional traders use. Here's what you'll learn. A price action tool. How to spot breakouts properly and avoid common traps. The best indicator for institutional moves. See exactly when the big players step in after a breakout. An institutional algorithm signal. Discover the one indicator that reveals when institutional algorithms are driving the market. We'll combine these tools into one simple, yet highly effective strategy that can take your trading to the next level. If you're ready to trade smarter, hit that like button and subscribe for more strategies and insights that can transform your trading game. Let's get started. One of the most reliable tools in price action is the trend line. It's simple to use but incredibly powerful when it comes to spotting breakouts. A trend line is a key tool in technical analysis that helps traders determine and visualize the direction in which a market is moving. To spot a trend line during an uptrend, you connect a series of higher lows with at least 2 points. This shows that the asset's price is rising over time, indicating bullish market conditions. For a downtrend, you connect at least 2 lower highs. This reflects that the price is declining over time, signaling bearish market sentiment. A frequent issue traders face is figuring out the best way to draw trend lines. Should you connect the wicks, the candle closes, or the bodies? Draw your trend lines in a way that captures the most touch points. The more touch points a trend line has, the more dependable it becomes. When the market exhibits higher highs and higher lows, follow these steps. Place the trend line beneath the price and connect as many lows as possible. Adjust the line to fit the overall movement of the price smoothly. If some candles slightly overlap or miss the trend line, that's fine. A trend line represents a zone, not a precise level. When the market shows lower highs and lower lows, follow these steps. Place the trend line above the price and connect as many highs as possible. Adjust the line to reflect the general flow of price movement. The aim isn't to make the trend line perfect, but to create one that effectively represents the market's overall structure. Now that you know how to spot and draw trend lines, let me show you what to look for in this strategy. Take a look at this example. Here the market is in an uptrend with a clear trend line. At this point we see a breakout below the trend line, signaling a potential trend reversal or at least a downward move. Spotting this breakout early allows us to join the downward move right from the beginning. Now, let's consider another example. Here, the market is trending downwards, forming a clear trend line. Notice what happens, a breakout above the trend line. This breakout suggests that the market is likely to reverse or at least make a move upward. Identifying this breakout early helps us catch the new upward trend as it begins. However, trading trendline breakouts alone isn't enough. Based on my backtesting, bullish breakouts have a success rate of around 62%. Bearish breakouts have a success rate of about 55%. While these numbers are decent, they're not reliable enough on their own. That's why we need additional tools to enhance the accuracy of this strategy. And this is where the volume indicator comes into play. Okay, so what is volume? Simply put, volume measures the number of assets traded during a specific time period. In the stock market, it's the number of shares exchanged. For cryptocurrency, it's the number of coins traded. In Forex, it's the volume of currency pairs bought and sold. Whether you're on a daily time frame or a smaller interval, volume shows how much activity is happening in the market. Okay, now to view volume on TradingView, head to the Indicators tab, search for volume and select the standard volume indicator. This tool uses vertical bars to represent trading activity. The taller the bar, the higher the volume. For example, a green bar shows strong buying interest on a day when prices rise, while a red bar reflects high selling interest on a down day. Here's why this matters. When price movement is backed by high volume, it signals strength and conviction behind the move. A green candle paired with high volume is especially bullish, indicating buyers are fully in control. Similarly, a red candle with high volume suggests strong selling pressure. Another way to think about it is selling interest. So for example, when we have a green candle supported by lots of volume, this is very bullish because not only is the price going up, but the price is going up while at the same time being supported by lots of buyers. On the flip side, when we have a red candle with high volume, it's bearish. The price is dropping and the move is supported by heavy selling pressure. Now, Let's combine trendline breakouts with the volume indicator to take this strategy to the next level. Take a look at this chart. Here, the market was trending down, forming a clear descending trend line. Notice what happens. The price breaks above the trend line, signaling a potential reversal from a downtrend to an uptrend. Now check the volume. A significant increase in volume during the breakout confirms strong buying interest, validating the breakout. And what happened next? The market moved upward, just as the strategy anticipated. Now, let's consider another example. Here, the market was trending up, forming a clear ascending trend line. The price breaks below the trend line, indicating a potential reversal from an uptrend to a downtrend. Look at the volume. There's a surge showing strong selling pressure, which reinforces the bearish signal. And as expected, the market dropped after the breakout. Okay, let me tell you something. According to my backtesting results, bullish breakouts, when confirmed by increased volume, have a success rate of around 74%. Bearish breakouts, when supported by selling pressure, have a success rate of approximately 69%. These win rates are impressive, but as traders, we strive for excellence. To truly filter out bad signals and focus only on the trades that make money, we need another powerful tool: the MACD indicator. The MACD is made up of three key components: the MACD line, the signal line, and the histogram. We focus on two critical signals. A bullish signal occurs when the MACD line crosses above the signal line. A bearish signal happens when the MACD line crosses below the signal line. We use the MACD indicator because it helps us align with institutional trading systems. Institutions often build their algorithms around MACD crossovers. When the MACD line crosses above the signal line, it suggests the market may move upward. Conversely, a bearish crossover, where the MACD line crosses below the signal line, signals a potential market drop. Institutional algorithms are designed to recognize and act on these signals, giving us confidence that we're following smart money. Now let me show you how to combine the MACD crossover with trendline breakouts and volume for the best trading results. Look at this 5-minute chart of Solana. Here we have a clear ascending trend line. We wait patiently for the price to break below the trend line, which signals a potential reversal to a downtrend. Next, to confirm this breakout is backed by strong selling pressure, we check the volume indicator. Notice how there's a surge in volume during the breakout. This tells us sellers are entering the market in large numbers. Now, what about institutional traders? Let's see if their algorithms are active. Look at the MACD indicator. The MACD line crossed below the signal line, confirming bearish momentum. What happened next? The market dropped significantly, proving this was a strong sell setup. Let's flip the script and look at a bullish scenario. Here's another 5-minute chart of Ethereum with a descending trend line. We wait for the price to break above the trend line, signaling a potential reversal to an uptrend. To confirm this breakout is supported by strong buying interest, we check the volume. See that spike in volume? That's a clear indication that buyers are stepping in. Now let's validate it further by looking at the MACD indicator. The MACD line crossed above the signal line, signaling bullish momentum. What happened next? The market rallied, giving us an excellent opportunity for a long trade. This strategy is one of the best trading strategies out there because it combines three powerful elements: trendline breakouts, a reliable signal that marks potential market reversals or continuations, and then volume. This confirms whether your signal is backed by strong buying or selling pressure, ensuring it's not a false move. And finally, the MACD crossover. A favorite among institutional algorithms, this indicator reveals if the big players are seeing the same setup you are, and whether they've already entered the market. Now that you've got the strategy, let's take it to the next level with top-down analysis. This approach ensures your trades align with the bigger picture, which is key to improving your win rate. Here's how it works. On your trading time frame, start by analyzing the chart. Draw the trend line and look for a breakout. Add the volume indicator to confirm that the breakout is supported by strong buying or selling pressure, and check the MACD for a crossover to validate the momentum. Next, move to the higher time frame to confirm the overall trend and key levels. This step ensures that the higher time frame supports your trade and doesn't present any conflicting signals. Once everything checks out on the higher time frame, return to your trading time frame to execute the trade. This process ensures you're trading with the bigger picture in mind while executing with precision on your chosen time frame. If you're trading the 5-minute or 15-minute chart, your higher time frame is the hourly chart. If you're trading the hourly chart, your higher time frame is the daily chart. For the 4-hour chart, use the weekly chart as your higher time frame. And if you trade the daily chart, your higher time frame is the monthly chart. Let's put everything we've learned into practice. Take a look at this 5-minute gold chart. The market was trending down, so we drew a clear trend line to track the movement. Then, the price broke above the trend line, which is our first signal that the market may change direction. Next, let's check the volume. Notice here how the buying volume starts to increase, confirming that more buyers are stepping in at the breakout point. This volume surge supports the validity of the breakout. Now let's look at the MACD indicator. We see a bullish MACD crossover, indicating that the market is likely to shift upward. At this point, we have all the criteria for a strong buy setup: trendline breakout, volume confirmation, and bullish MACD crossover. Now, let's move to the higher time frame to ensure our setup aligns with the broader market trend. Since we're trading on the 5-minute chart, the higher time frame is the hourly chart. On the hourly chart, focus on the trend direction, not the MACD or volume. The market is currently ranging between a clear resistance level and support level. The market was rejected from the support level, suggesting it's likely to move up and test at least the minor resistance level. This top-down analysis confirms that the higher time frame does not conflict with our buy signal on the 5-minute chart. Let's return to the 5-minute chart and see how to execute this trade. Place your entry at the close of the candle that broke above the trend line. Place your stop loss below the minor level near the breakout, and set your target at twice the risk. What happened next? The market moved exactly as expected, reaching your target and confirming the strength of this strategy. Let's look at another example, this time on the 5-minute Canadian dollar, Swiss franc chart. The market was trending down but then started moving against the trend. We drew this trend line and noticed a breakout below it, which is our first signal that the market might continue downward. Now, let's check the volume indicator. As you can see, selling volume increased significantly, especially at the breakout. This tells us that more sellers are entering the market, adding strength to the breakout. Next, look at the MACD indicator. The bearish MACD crossover confirms that the market is likely to go down. This signal is often picked up by institutional algorithms, and we know that these algorithms likely entered the market even before the breakout, helping to drive it. We now have 3 powerful pieces of information: breakout of the trend line, increase in selling volume, and bearish MACD crossover. Everything aligns to suggest this is a high-quality trade setup. Now let's check the hourly chart, which is the higher time frame for the 5-minute chart. On the hourly chart, the market was previously trending up, forming a trend line. That trend line has now broken, indicating a potential reversal to the downside. We also see a liquidity sweep at a minor resistance level. This is a strong signal that sellers are dominating and that the market is likely to move downward. If you're unfamiliar with liquidity sweeps, check out my channel where I have a detailed video explaining this concept. With the trendline breakout and liquidity sweep on the hourly chart, we have strong confirmation that supports our setup on the 5-minute chart. Returning to the 5-minute chart, here's how we execute the trade. Place your entry at the close of the candle that broke below the trend line. Set your stop loss just above the breakout level. Aim for a reward twice the size of your risk. What happened next? The market moved exactly as expected, hitting our target and confirming the effectiveness of this strategy. That's it for this strategy, traders. You now have all the tools to spot high probability setups like the pros. If you found this video helpful, hit the like button to show your support, and don't forget to subscribe for more strategies and insights. Let me know in the comments how you're using this strategy. I'd love to hear your success stories. Until next time, trade smart and stay disciplined.